Welcome back, focus learners, to our latest explainer. If you've ever sat there staring at a trading chart, faithfully following all the traditional advice, drawing your lines, waiting patiently for those crossovers, and still found yourself inexplicably getting stopped out, well, you are in exactly the right place today. We're kicking off a brand new series, and the goal? To completely shatter the illusion of traditional technical analysis. We're going to pull back the curtain and see exactly how the smartest, most well-funded quantitative researchers on the planet actually use market data. And I can promise you right now, it looks absolutely nothing like a typical retail trading setup. Okay, let's dive into this.
First things first, we need to explicitly debunk a massive myth. The retail trading world is completely obsessed with looking for visual buy signals, right? You know the drill, waiting for one simple moving average to finally cross over another, or trying to trade off a MACD line. Well, that's the retail myth. The institutional reality? It is a completely different universe. Quants aren't sitting around staring at line graphs. Instead, they treat indicators as raw mathematical ingredients for an algorithm. Think of it kind of like baking. Instead of just looking at the superficial baked color of a cake, these guys are calculating the exact chemical reactions of the flour and the sugar. They use highly advanced statistical transforms of time series data, stuff like realized volatility or volume z-scores, and they feed that raw data directly into automated machine learning pipelines to generate their predictions. You literally won't even see these lines on a standard chart.
So that brings us to the golden question. If the smartest, most well-capitalized money in the room isn't just staring at an RSI crossover, what exactly do they use to pull the trigger? Well, it's time to leave the hobbyist tools behind and step into a completely different framework. We are going to explore what institutions actually call the indicator zoo. Let's see what kind of wild stuff is actually in there.
You see, quants don't just use an indicator. They actually classify them into specific zoological categories based on the underlying math they're trying to capture. Let's take a super quick tour of that zoo. First up, we have order imbalance. This is essentially weighing the scales to see if the buy side of the limit order book is artificially heavier than the sell side, which helps predict an imminent move. Second is trade autocorrelation. Think of this one like detective work. It detects when a massive institutional whale is trying to hide their tracks by slicing one giant order into tiny algorithmic pieces over time. That leaves a predictable directional footprint. Third, we've got volume clustering, which is all about identifying those sharp, unusual spikes in volume that act as leading indicators for future activity. And fourth is relative value. That's basically checking a specific asset against its related sector to see if it's drifted just a little too far from its family pack.
Now, rather than just blindly scanning for buy or sell signals, quants are actually out there hunting for market regimes. To do this, they use sophisticated statistical tools called hidden Markov models, or HMMs for short. These models estimate the probability of the market's current regime or its mood. Is it trending up? Is it just ranging sideways? Or is it trending down? And this brilliantly illustrates why a typical retail strategy so often fails. Think about it like driving a car. You wouldn't use summer tires in the middle of a blizzard, right? A trend-following indicator that absolutely prints money in a bull mood is going to completely bankrupt a portfolio in a sideways mood. HMMs are so crucial because they dynamically tell the automated systems which specific strategies to turn on and which ones to forcefully shut off based entirely on the current environment.
Now, believe it or not, there's actually a magic number that governs a lot of this chaos. 5. When quants are looking at the market, they aren't agonizing over daily candles or long-term chart formations. They rely heavily on high-frequency data, specifically broken down into 5-minute windows. Within these 5-minute windows, they define what are known as noise areas or equilibrium zones. And the logic here is just beautifully elegant. As long as the price stays within a certain mathematically predicted range during those 5 minutes, buyers and sellers are perfectly in balance. Any movement inside that window, it's not a signal at all. It's literally just random market noise meant to shake out weak hands.
But how do they actually know when it's no longer just noise? Well, that's where a quantitative indicator like normalized excess demand, or NED, comes into play. Quants monitor these 5-minute equilibrium zones like hawks, but they only take action when an indicator like the NED violently crosses a very specific, pre-calculated mathematical threshold. When that threshold finally snaps, it's not a drill. It signals that the equilibrium is officially dead, the balance between buyers and sellers is broken, and a true, actionable market trend has just ignited. That is exactly when the big money moves.
Now you might be sitting there thinking this whole thing is entirely run by cold black box robots. And while most processes are indeed completely automated, sometimes the output of these highly complex formulas requires what's called a human in the loop.
For example, an algorithm might run a super complex options pricing formula, compare the fair value of that option to its real traded price, and then calculate the z-score, the standard deviation of that difference. But here's the thing. Algorithms can't read the morning news, and they don't truly understand global geopolitical context. So those specific signals are output live onto a terminal for a real human trader to monitor. The human acts as a critical failsafe against black swan events, making the final call. It's basically the institutional version of a dashboard warning light.
Let's shift gears for a second and talk about institutional fear. Because yes, even the giants are terrified of adverse selection. That's the risk of taking the other side of a trade against someone who secretly knows something they don't. To protect themselves, they use an indicator called VPN, which stands for Volume Synchronized Probability of Informed Trading. Simply put, VPN measures toxic order flow. Think back to the infamous 2010 flash crash. Indicators like VPN are the ultimate warning sirens designed to prevent getting caught in exactly that kind of carnage. If VPN spikes, it means smart money is actively overwhelming the market makers. It's literally screaming at quants to pull their money out before liquidity entirely collapses.
Okay, so what happens when it is finally time to actually buy? Institutions face a totally unique problem that retail traders literally never have to deal with. They are moving so much money, we're talking billions of dollars here, that they could literally break the asset's price and cause a massive artificial spike if they just bought it all at once. So to handle this, they use the VWAP, the volume-weighted average price, as their absolute baseline metric. You see, institutions aren't necessarily trying to buy at the absolute lowest bottom like a retail trader might. They're simply trying to leave footprints that are better than the day's average price. If their algorithm can successfully execute a massive order below the VWAP, blending right in with normal volume, they consider that a massive win for their clients. Finally, we have this fascinating concept of checking the checker, which is known in the industry as meta-labeling. So, the crucial point is how this two-step process fiercely protects capital. Think of this like getting a second medical opinion before you go in for major surgery. Step 1 is the base strategy actually signaling the trade, saying, yes, all our models say we should buy here. But before a single dollar is actually spec'd, step 2 kicks in. A secondary, highly skeptical machine learning model audits that decision. It looks at a whole array of institutional indicators to determine the actual mathematical probability of that trade being profitable, and then it sizes the position accordingly. If the first model says buy, but the second model sees low probability in the broader indicators, no way. It will override the system and say, hold on, let's only buy 10% of our usual size.
Wow, we have covered a tremendous amount of ground today, completely rethinking how market data is used by the absolute best in the business. We've toured the indicator zoo, looked at hidden Markov models, dynamically shifting strategies, explored toxic order flow with VPN, and seen how meta-labeling acts as a high-tech failsafe for massive portfolios. But honestly, this is just the beginning of our series. Now that you've seen the whole zoo, which cage should we unlock first? Think about which of these quantitative tools challenges your current view of the market the most. In our next explainer, we'll be diving deep into the math behind the very first cage. Until then, I want you to ask yourself, are the indicators on your screen actually telling you the truth, or are they just the noise that the algorithms are preying on?